welcome to our Taking Stock video for the week ending the 23rd of July 2021, where today I have the pleasure of welcoming Matthew Swartz, our portfolio manager, together with myself, Kien, Trinh, to stream to you all things share market. Thanks for joining us today, Matt, and quite timely because we're now right on the doorstep of our reporting season.
Oh, we are, and thank you for having me there, Kien.
So as the global economy recovers, the Australian market has experienced 11 months of earnings upgrades, and this should lead to strong results and dividends, especially across those cyclical sectors such as the banks, the resources, building materials, media and retail. And on screen, you'll be able to see a list of our star stocks that are exposed to those sectors. In the growth universe, the list is sorted in order of companies that are expected to post the strongest earnings growth for this financial year. There are stocks like Mount Gibson, South32, Lovisa, Johns Lyng, BlueScope Steel, and Aristocrat Leisure. And within the tech space, we expect earnings growth for Xero and Right to also recover as well. And for our star income investors, we can sort the list for cyclical stocks that are paying the most attractive dividend yields in financial year 22. And those high on the list include iron ore stocks like Fortescue, Rio Tinto, and BHP. Others that still look attractive are the retailers like Adairs, Nick Scully, and JB Hi-Fi, which are expected to pay a gross dividend yield in excess of 7%, and that's despite slowing earnings growth expectations for the year. And of course, you can reproduce this list using our filtering tool and selecting star stocks in the cyclical sectors, then sorting the list by forecast earnings growth or dividend yield.
Yeah, and we've experienced some upward earnings revisions over the last few months, and that has led to even more positive earnings growth expectations for financial year 22. Now, the chart on screen here shows the earnings growth expectations for the market split across these high level sectors rather, banks, property, resources, and industrials. Interestingly, with commodity prices continuing to be sustained at these high levels, analysts now anticipate earnings growth for resources stocks into financial year 22, where before they were expecting obviously earnings to come off a little bit because of the very high commodity price environment. So this dynamic will be supportive for cash flows for at least another year, so we can expect to see elevated dividends for these non-traditional income stocks for another few periods ahead.
Yes, Matt, just a few months ago, forecasts were anticipating negative earnings growth for those resources sector, especially in this financial year, but things are starting to change very quickly. And among the mining quarterly updates, our star resource companies reported in line with market expectations, especially with diversified miner BHP performing quite well, expecting production in financial year 22 to be in line with the previous year. On the other hand, our gold stocks like Northern Star and Evolution Mining, they were able to meet guidance expectations. And positively, Newcrest also finished production above guidance as well. In the meantime, star stocks, your Rio Tintos, your BHP and Fortescue and Mount Gibson, they are offering forward gross dividends in the range of about 7 to 20%. And within this group of stocks, Mount Gibson is about to embark on this next stage of their mining plan, targeting high-grade iron ore zones, and this is why earnings growth is expected to accelerate this year for Mount Gibson. And of course, investors should be mindful of the risks associated with these companies, particularly around commodity prices, and these risks can be found in the strategic and active risk comments in our analyst commentary.
Yeah, those dividend yield forecasts are certainly eye-watering, particularly for the miners, aren't they, Kien? But look, we can't be too complacent. As we're all aware, the COVID Delta variant has made its way onto our shores, and state governments are imposing hard lockdowns across our country's most populous cities. So we will be very interested to hear from management teams of corporate Australia to provide some clarity around the operating disruptions caused by these new set of lockdowns. This is especially true across the banks and any of the stocks closely tied to the economic recovery. Now, of course, the stocks that performed well during the lockdown extensions include healthcare stocks like Fisher & Paykel, CSL, ResMed and Ansell, and many consumer stocks also fared fairly well last year with Adairs, Nick Scali, ARB Group and ARB Corp and Wesfarmers all delivering exceptionally strong results. Now, from a fund perspective, we're fairly confident in our positioning leading into reporting period. Over the last few weeks, we've observed a number of upbeat operating updates and some guidance upgrades amongst a number of our consumer stocks. And now within the banking sector, I think it appears extremely well capitalised, and we're likely to hear more announcements about buybacks following on from ANZ's report last week about an on-market buyback. We expect to see potentially CBA at their result coming up with an off-market buyback, which will be encouraging for our income investors. And we're also confident that the offshore earners in healthcare, such as Cochlear, CSL, Fisher and Paykel, ResMed, will deliver pretty strong quarterly and half-yearly results. And that's certainly been the trend in the quarterly US reporting period. So hopefully that foreshadows some very good news ahead.
Yeah, that's right. And you mentioned, Matt, those consumer stocks, and there have been some concerns around those retail sales, especially with recent data revealing a 1.8% decline in June as lockdowns across Australia restrict the movement and force stores to temporarily close their doors. And this trend is likely to continue into July, with Sydney's lockdown now expected to be extended and could also lead to an economic contraction in the September quarter. But to us, I think investors should not be too concerned, because if you think about lockdowns, they tend to increase consumer savings rates. And also people, they reduce their travel, and that also leads to rising online sales as well. Furthermore, you've got the potential for further government support measures, and that provides a cushion to the economy as well. For example, we had JB Hi-Fi in its recent update. They said that demand remains strong and they expect earnings to rise 67% in financial year 21, and that was 7% above consensus expectations. Now, the result was driven by increasing demand for high margin appliances and consumer electronics, and that enables the company to reduce their discounting and also keep their costs under control as well. Meanwhile, online sales have risen 78% over the year and now represents close to 12% of their total sales.
Yeah, that strong earnings momentum into the fourth quarter has analysts expecting this to spill over into financial year 22, and we have seen some further upgrades to expectations for this year. Of course, better than expected cash flows for the year will continue to support the gross dividend yield, currently sitting at around 6% for financial year 22. The fund holds a position in JB Hi-Fi across both of our Australian strategies, and this is unlikely to change over the next few months. But the company did mention, however, that lockdowns would cause some level of disruption in July and possibly into August, depending on the length of these lockdowns. So we will learn a little bit more about the impact that has on the business operationally when they provide their trading update at the result in August.
Yeah, thanks, Matt. And moving on from retail to healthcare, Australia's largest private hospital operator, Ramsay Healthcare, they failed in their cash bid for UK operator Spire Healthcare after a lack of shareholder votes in support of the deal. Now, the transaction would have created a new market-leading independent private hospital operator in the UK. Although the news is disappointing, we do not believe this will have a material impact on near-term earnings forecasts, given the synergies from the deal were not anticipated to flow through until financial year 23. Meanwhile, management may pursue alternative strategies to secure a Spire at a later date.
Yeah, and we were mindful of the risks of the acquisition, such as the additional debt needed, which could have derailed Ramsay's financial health. And note that Ramsay already had quite a high or vulnerable balance sheet leading into the acquisition, with its total liability to tangible assets ratio. Also, its net debt to equity is at 78%, which is relatively high. And in addition to that, the offer price was not particularly cheap, and this could have led to write-downs and a dilution to earnings into the future.
Okay, turning our attention now to our corporate calendar. Iron ore producer Rio Tinto, they are anticipated to provide their interim report on the 28th of July. On the 29th of July, you've got Macquarie Group. They are expected to host the AGM, while IOOF and Sandfire Resources should provide their June quarter updates as well. From a technical and for trend sensitive investors as well, the stocks that turned bearish on the SD Max, that's the stock doctor moving average crossover during the week, are Collins Foods, National Australia Bank, Sandfire Resources, and Westpac as well. There were no changes observed on the SD 30 TSR, which is the 30% stop loss. For Under the Microscope this week, we want to highlight our recent initiation of Technology One. The company develops software to help mainly governments and councils manage their supply chain, their human resources, and payroll functions more efficiently. Due to their defensive client base, the company performed well during COVID. For example, with 85% of revenues generated from government, education, and healthcare sectors, the business was COVID-proof given their software is required for mission-critical tasks. With a 99% customer retention rate, the company plans to transition to a fully subscription-based operating model, which should help generate strong earnings growth in the years to come. But a few clients had wondered why we didn't cover this stock following the release of their first half results, which seemed okay. We were mindful that Adrian DeMarco and cornerstone investor John McTaggart, they sold down some 60 million in stock, or 10% over this time. So we wanted to wait to ensure there were no operational issues that would come to the surface. After further assessment, we believe the risk of insider selling is now minimal. Both Adrian and John still have plenty of skin in the game, with a combined 18% of total shares on issue. Now, regarding outlook, we see a long runway for growth both in Australia and offshore markets of UK, Asia, and New Zealand, and that's supported by new customer wins and also the movement to this subscription-based model. The business offers high returns on equity with potential for improvement given profit margins are now targeted to grow from a current 24% to 30% in the next few years, while earnings growth is also expected to be around that 10% moving forward as well.
Yeah, but before making an investment, investors should refer to the active risk sections in Stock Doctor. Our analysts articulate the risk with regards to its underperforming UK segment, the broader competitive landscape, and the company's fairly aggressive accounting policies. And this is effectively centered around the company's habit of aggressively capitalizing its development costs. And it hasn't gone unnoticed within the broader investment community, with the company having to endure a number of short selling reports over the years. So on balance, this has created some volatility within the stock.
So we've spoken about the Australian reporting season, but the US markets have rallied strongly as they enter their second quarter reporting season. So Matt, given you are managing the US fund, what are some of the key themes you are seeing over there, and how are you positioning the fund?
Well, look, we are only 15% of the way through that second quarter, but on that point of key themes, the trend at least of beating analyst expectations has certainly continued. In fact, since the back end of 2020, the earnings surprise index, which is a measure of the ratio of earnings beats relative to earnings misses, that has been the highest we've observed on record. And this is sort of dating back 20 odd years. So the best way to interpret this is simply that Wall Street analysts continue to underestimate the earnings recovery that's taking place in the US at the moment.
Yeah, and on top of that, the US companies are expected to report the highest year-on-year earnings growth since quarter four 2009 at 64%. And given that the reporting season is off to a great start, we're most likely going to see an eclipse of expectations. Similarly to our market, most of the growth has come from the cyclical sectors like consumer discretionary, financials, and materials. And looking forward, analysts are also projecting double-digit earnings growth for the remaining 2 quarters of 2021, and that should help support the market and also our US fund performance. So Matt, many of our clients are interested in diversifying their equity exposure into the US stocks, but often hesitate because of the currency volatility and how that can impact returns. How does the fund team deal with the currency risk?
Yeah, interesting question, Kien. And look, I oftentimes get asked the same question by clients, and it is surprising to me that Aussie investors tend to stay in the Australian market when you have a look at the US market and the breadth of some of these tech behemoths and so many great companies that they do hesitate to invest in that market. But you only really need to look at the Aussie dollar US dollar currency pair over the past 12 months to understand why there is that level of hesitation. We saw in the depths of that market panic in March 2020, the Aussie dollar drop 20% over the course of that month. And a year later, they've rallied over 40%. So what would that mean to you had you have invested, taken the opportunity to buy the dip in March 2020, bought a portfolio of US stocks? with a 40% rally in the Australian dollar, that would mean that effectively the equity prices of those US stocks that you bought in March 2020 would have needed to appreciate some 40% just for you to break even. So most people obviously prefer not to have to deal with that level of risk. And this is exactly why we offer exposure to our US funds with the option of hedging your currency exposure.
Yeah, so as an investor, if you believe the Australian dollar is going to rise, then a hedge fund would be the optimal area you want to invest in. But just out of interest, Matt, how has the US fund performed in its maiden year?
But we've been happy, but there has been obviously some challenges, and we've spoken to this at length, particularly in since the start of calendar year 2021. We've noticed that aggressive sort of transitioning from growth stocks into recovery plays, particularly in the US, and the currency hedge fund has delivered absolute solid returns of 25%, but underperformed its benchmark under those type of conditions. But we're obviously pleased with that outcome, and investors that supported us from day dot are off to a very, very good start. But look, at the end of the day, it's been fairly easy to make money over the last year. In fact, it seems as though the further up the risk spectrum that you travel, the better the returns have been. And that's in part reflective of the broader economic recovery, but it's also a function of what we are looking at as excessive speculation going on at the moment. And Lincoln, as you know, and Tim talks to all the time, we're not in the business of speculating. So you're not going to see Lincoln catch meme stock mania and add stuff like GameStop or AMC into our portfolios, and we're certainly not going to participate in the pumping up of worthless cryptocurrencies. Our approach will always be focused on the fundamentals. I know that doesn't sound appealing when your neighbours have potentially made $1,000 buying Dogecoin, but our approach of biasing our exposures is to the financially healthy and quality and growth factors to us seems appropriate, and obviously from our back-tested models, it tends to deliver superior risk-adjusted returns over that long-term period.
Yeah, as we know, Matt, from history, when you're speculating in a lot of these stocks, we know what happens. And so that's why we have that financial health model to protect us. But thanks, Matt, for sharing with us your insights.
No, it's been my pleasure. Thank you for having me.
So the quarterly mining updates just recently that we're going through now suggest that it will be a strong reporting season for resource stocks. In fact, earnings growth for this sector is expected to be positive in financial year 22, and that's a stark difference to expectations we saw a few months ago. Cyclical stocks, like those in materials and financials, will continue to do well on the back of this global economic recovery, but recent statewide lockdowns may cause a short-term setback to outlook statements. So be careful of investing in those speculative stocks, that is, stocks that are financially unhealthy with a lack of positive cash flows. Have a happy, healthy, and prosperous week, everyone.